what's going on? I've just had an absolute mare recording the first one, so hopefully this goes a tiny bit better. Basically, I've come on here to just tell you how I think a portfolio or your wealth allocation should look like in 2021. Obviously, I had a lot of time in 2020 to think about it. I did property at the start of 2020 March, and we finished our first property or buy to let then, because basically I was building passive income to go traveling. That still is the goal, ultimately, to go traveling, but I've now saved the cash to do that. So all the passive income I'm making at the moment needs to go back into investments to use compound interest in, or interest. I have a lot of people say to me, "Oh, how can you make me money?" or "How can I make money?" Now, because I'm not trying to be a fund manager, because I think most of them are dodgy, I'm just going to tell you what exactly I'm doing, whether it's working, whether it's not, and then you can choose whether or not to do it. It's completely up to you. But yeah, so behind me I've written like what I think that you should be allocated to. So if you just get your whole total amount of money, like if that's all in cash at the moment, and then spread it out into these certain things, which is what I'm going to try to achieve. So I'll just run you through it. So I'm on my bed, so that's why I'm moving around like that. But yeah, so basically you've got 10% gold at the top, and that's also including Bitcoin. Anything which is in a finite amount does well in an inflationary environment. So, when they print a lot of money and create a lot of fiat currency, anything which is in a finite amount does very well, and it usually goes up in value. So gold, Bitcoin, silver, any sort of precious metals and commodities, well, in my opinion, I think commodities are going to go up, and already are, such as food, oil, things like this, and clean energy things. So yeah, 10% on gold and silver, that's a hedge against inflation. And one thing I actually forgot, which, by the way, I wrote this before the bottom bit, because I was thinking about what would be ideal, like allocation. I actually forgot cash, because cash is a position. So you've got inflation or deflation, and at the moment it is kind of an argument of which one's going to happen, unless it's just like flat lines forever, because they lie about the statistics. But yeah, so if it's deflation and everything goes down in value, cash is a position, because the cash which you have goes up in value. Because obviously, when people are trying to get rid of their houses and stuff like that, your cash is really important to them, because they want to get liquid as soon as possible. So having cash is actually a position. I didn't put that at the start, therefore I didn't put it into like the 100% calculation. So this is going to be a bit skew with, but we'll talk through that anyway. And then, so 10% is startup. So this is actually a wicked thing about posting on social media. Like, I've been speaking to a lot of you guys, and you'll know who you are getting the advice for this. But I was speaking to someone about startups, and effectively there are real good tax benefits to investing in startups in the UK. It's called EIS, and it's a scheme which gives you about 60% of your money invested back if you lose, because 9 out of 10 companies or 9 out of 10 startups fail. So what you're trying to go for is like 300, 400%. You invest in 10 or so companies, and then 1 out of them 10 or 2 out of them 10, depending on how good you are, or doing your due diligence on these companies, will do well. But for the other companies which haven't done well, you can get a tax write-off. So if you're an earner, so if you're a 40% earner, you should definitely be doing this. If you're a 20% earner, then you should be doing it anyway. And what I mean by earner is if you're employed. So in my case, I'm an engineer, I'm employed. This is a good idea to write some more tax off. No, I'm not a tax dodger completely. I do follow the rules, but you can move within them rules or do investment strategies which give you a better placement. So yeah, that's something I'm going to work on. In the next few weeks and months, I'm probably going to put a lot of stuff on social media, and just I'm just going to show you what I'm doing, see whether I'm failing. I'll sort of be your guinea pig to see whether it works or not. So I might lose a bit of money, but here we go. You got to take risks when you're young. Do you know what I mean? So 10% short startups, and then short-term trading, which is in 212 at the moment. And when I say short-term, I don't mean like swing trading. Swing trading means like, every day you got to be looking at the markets. And to be honest, for me, that's just a stressful situation. All of this investing stuff and this passive income is not to get like another job or to be like full on in something and looking at shares all the time, because it's not full on. It's not my, I'm passionate about it, but it's not my true passion. Like, I like being outdoors. I don't want to be on my phone all the time checking through the stock market results. I think business is cool, entrepreneurship is cool, but that's about it. You don't want to be, in my opinion, you don't want to be on it all day. So when I say short term, I'm talking about like 5 years, 3 or 5 years, what stocks are going to be doing well. At the moment, I've got like a lot of commodities like oil. I've already said that. I think it's going to do well in the short term. I've also bought like stocks like pet foods, because I know like a lot of people watching this probably have got like dogs in the interim, because they've been in I'm just building my own theories in my head, but like for instance, a lot of people have been in lockdown, and because they've been lonely or whatever, they've bought dogs and rightly so, because dogs are pretty cool. And then because of that, they bought dogs, and then obviously the knock-on effect is to buy dog food. And while they're printing money, there's more money chasing, these certain objects, which are food, dog food, whatever. Then you see an inflationary rise, and these companies can then, their income starts going up. So they're sort of my outlooks on the actual stock market and what I'm doing short term. But I'm thinking like 3 years that inflation will still be happening. So yeah, and then also 30% ETF and index. I think I want to be heavily weighted there, because like I just said, like I don't really care for investing too much like actively. So ETFs are just a good way of doing that, like constantly putting into the market, dollar cost averaging, which is every month you get paid, you're just constantly putting in. And I've done this for about a year before with Vanguard on FTSE 100, and it was brilliant. So it was just difficult to get liquid after. It took like 9 days. But I mean, there are theories. This is the thing. When you're on the internet, you can find theories for and against absolutely everything. Now, I know there's definitely the guy who predicted the stock market crash in the property bubble for 2008 actually says that ETFs are a bubble. Now, that kind of, makes me a little bit scared, but that's why you got to diversify your total investment. Like, so if someone's 100% in property, like, yeah, I get that you probably understand property 100%, but what about if say for instance, if I just got a single lets, like 20 single lets, what about if single lets is a bad example because it's not like specific, but HMOs for instance, like students, if I just got all students, and then not and I'm 100% allocated to that in my total wealth, and next year, because students have been mugged off this year, they just completely like don't sign up for university, then what happens? You get voids, and your wealth or your generation of wealth won't be that great. So I think like sort of diversifying it in total like is good. So and then last one is 40% property. Now obviously you all know, it's probably why a few of you follow me anyway, property is like my main thing, like that's the thing I'm passionate about. I think at the moment it's a bit of a confusing one whether we're investing or not. There's a lot of investors who have just gone to the sideline, which I think is smart. I think playing it both ways, like playing a bit of a long-term game, like where you just invest in and it doesn't matter, it's timing the market rather than timing the market. That's what they say in stock investing, but I think also it stands for property as well. I think we are sort of near the top if we're honest. But like I say, if you just invest now and then keep a cash buffer as well, you've got dry powder for when things do go south, and then you can start investing again. But then also with property, I also believe, like for me anyway, when it gets to a certain point where I can see good opportunities, I will then be able to go like ask for investor finance and stuff like that, and hopefully get a joint venture partner. I know a few people have been speaking to me or watching me through these platforms, so hopefully we can build a relationship and invest in the future. So that would be my sort of target for property in the future anyway. But yeah, so this is how it looks like. So gold and silver 3.5%, startups 0%, short term investing is 2.2%, ETF is 0.3%, property is 35.8%, and cash is 58%. So as you can see, like cash is huge. And by the way, I didn't put the numbers on it because I didn't want to either flex or not flex. For some of you who probably are watching, if you've got to 9 minutes 37, then congratulations. But yeah, so you can see I need to do startups. This is what I'm going to be doing over the next few weeks, I think. If you want to hear about this more, then let me know. Either direct message me or drop something in the messages. Whether you'd like me to see me do like YouTube channels and go through in more detail what I'm actually talking about or what I'm trying to do, because I'm going to probably fail a lot in the beginning of that. The gold and silver, I'm in iShares Gold Trust, which is an ETF or a tracker which tracks like they own the actual physical gold. It's called iShares Physical Gold, iShares Physical Silver. So you're not just trying to track the market. So they actually own the gold. So if they were to liquidate it, they'd have to sell the gold, which is a good thing, because if you think about this apocalyptic scenario where hyperinflation happens, there'll be a lot of demand for gold. And I think it was like in 1970, the US government actually banned gold and they bought it at a certain price. Now, obviously, you'd want to own it at that point, not just be tracking it. So, yeah, having iShares Gold, I think, is a good thing. That's how I understand it anyway. Maybe that's not true. Short-term investing, I've already told you about that. ETF, I've just started back on that, so that's why it's so small. But for the next few months, obviously, I've got the cash buffers, both for property and for the travelling, which I talked about earlier. So I'm just now going to push all the cash flow I have or all my savings into these accounts and trying to build, startups, ETFs in the short term up to a certain point, which I've spoke about here, like 10% of the total wealth distribution. So, and the other thing is, like, the reason I've probably taken on this is because when they say cash is trash, like, that's an important factor to think. Like, like most savers or most people go through life just saving money in their bank accounts, and if you get smashed by inflation, you're done. But if you can sort of like invest here and there, like, it doesn't require you to get all of your cash and just chuck it into the stock market or whatever. This is why you should have multiple parts, or they say multiple income streams. But yeah, this is the importance of doing that, because if you're in cash, all you're doing is hedging against deflation. And like, because the government are so smart now with their monetary policies and stuff like that, I mean, interest rates have been like 2% for so long. Like, I'm pretty sure it's impossible for all of these factors to actually take place unless you like fix statistics. But I can't remember where I was going with that. But if you stick it in, if you hold it in a cash in an account, all you're doing is hedging against deflation. Now, that would have worked in 2008 crash and a few other scenarios. But I just think the government are a lot smarter now. So deflation's probably not an option. So maybe you'll see deflation in certain markets like property, and then inflation in other markets like stocks and stuff like that. I mean, you're already seeing that anyway, because like, if you look around the high streets, all the shops are like shutting down, getting rid of people, etc., etc., and the stock market's just running riot. So you can see these disconnects happening. Like, food prices are going up, but people aren't earning more. So you can see these disconnects happening all over the place. So you just got to think for yourself, what do you think is going to happen with property? All of these markets. One thing I would advise is just critical thinking, not like following everyone on Instagram who's like saying, yeah, we should hustle, blah, blah, blah. It's like, no, just be smart about what you're doing. And they'll be the true winners out of these scenarios. Now, I'm not trying to win on the back of other people's like misery or whatever, but this is a game. This is why I enjoy finding opportunities. I'm not like trying to benefit from other people. I am just trying to find opportunities. That's the way I see it anyway. So, but the last thing I wanted to do or say was that, obviously, if you are building, or I am building, a property portfolio or income / business, so this is how I see it. Like, I would like the property income to go into stocks, so and then that stocks to pay off the debt. At the moment, I don't actually need the income. So if I did, it might be somewhere in here. I'd maybe get like dividend stocks, and then that would pay off that. But what you're doing is, like, say if you do 150, you're putting the 150 into stocks, then earning like, I don't know, 10% of that, so that's £15 a year or whatever, and then you're taking that back out in dividends, or how. I don't think dividends would be the same. I think 2% is probably a realistic dividend, so it'd be very small. But you know, it's better just to use compound interest in this case. So you want to just be reinvesting everything. So paying off debt is kind of technically reinvesting because you're lowering your leverage rate. But yeah, if you pay a net to yourself, then yeah, eventually you might get to that stage where you actually don't have to have a job. Your property income goes into the stock market or whatever, you know, startups, etc., and then this sort of income pays you off. But it's, the way I see it is many routes you can go through before paying yourself to make the money work is a good thing. Yeah, because I mean, there's been tons of books I've read, but what was it? The something of Babylon, the richest man in Babylon or something. He talks about like you know, how I'm sure it might be Rich Dad Poor Dad where he talks about quadrants, but the flow of cash is important as well. Like, you know, it should be invested. Investors, it's working. That's what they say. It's working as hard as possible, and that's the important thing. You got to try and make it work as hard as possible. So I hope that was useful. Let me know if it was. Drop a comment in the box below and let's chat. Bye.